Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Welcome to our latest episode of Colliers Talks. I'm Tanya Lagrasta, head of ESG within Real Estate Management Services Group here in Canada, and today I'm joined by with three of my colleagues, all of which I have had the incredible pleasure of engaging with on a variety of inspiring and complex conversations. First, I'd like to introduce my colleague, John Duda, president of Colliers Real Estate Management Services. And with his leadership, we've built out our incredible ESG and sustainability platform, really aimed at delivering superior asset results for first-in-class office, retail, and industrial properties that we manage across this lovely country. Next, we have Jag Singh, Director of Sustainable Investing at Fiera Real Estate, Bojena Jankowska, Managing Director, Global Head of ESG at Slate Asset Management, both of whom I have worked with very closely over recent years to help develop portfolio level strategy and execute tailored implementation plans, which we're actively executing at all assets across the country in varying scopes and scales. And so if we fast forward to the last year or two, we've really, I think, would all agree that we're up against probably one of the most economically turbulent times in the longer stretch of the decade. And I was hoping that we could kind of all walk through what that's been looking like in our various organizations. Maybe Bojena, I'll start with you. If you could think about how this current state is impacting your company's prioritization of ESG and sustainability and the investments that are required to deliver on your goals. Has your decision making changed, and if so, in what ways?
Yeah, hi Tanya, and thanks very much for having me on this episode. I'm delighted to be here. Wow, where do I start? So yes, indeed, we've been at Slate looking at what's happening across the market in all the different geographic locations where we are, which is both Europe and in North America, and whether that has, if you like, moved ESG priorities down the pecking order of general priorities. I certainly haven't seen that. I think the discussions continue to be the same around ESG, and I think it's really the kind of time horizon you're thinking over when you're thinking about ESG. I think there's definitely a recognition and acknowledgement that investors are still focused on ESG in various forms and guises, and that's not going to be going away. When we're getting, for example, due diligence questionnaires from prospective investors, the ESG questions have just scaled up over the years that we've been answering them. They were pretty straightforward a few years ago, and now they've become more complex, more demanding, more questions being asked, and really trying to get into the meat of what do you do and what you do on ESG and how you do it. So I don't see that being scaled back. And so with Slate's perspective, we do obviously care what our investors want. We want to make sure we can align with our investors' objectives. And so the ESG topic isn't going away. And I think also, if you think about the horizon and the climate change, the 2030 is looming, 2050, okay, a little bit further out, but you need to start putting plans into place today. And I think if you're a long-term investor, a sustainable investor, in sustainable, I mean in all senses sustainable from an economic standpoint, environmental standpoint, you kind of have to obviously adapt your strategy to the short term, but you always have your eye on the long term. And I don't see that changing. We're still having the same focus, objectives and priorities haven't changed.
Jag, I want to say, similar to you, would love to hear, from your view, being Canadian based primarily, when you think about that as Bojana articulated, and what's the core theme here is when we think about ESG and investing in ESG and sustainability and the economic life cycle of your assets and your funds and your portfolios, from the Canadian perspective and from the Fiera perspective, what are you seeing, and has anything really deviated significantly from your original course?
Yeah, no, that's such a great question, and very similar to what Bojana has described. I think the Fiera experience has been that investors are still very much curious and inclined to ask many questions around our sustainable investing practices. I think what the pandemic really did was shift sustainable investing, ESG, into the front and center, and it really made standard business operations and integrating sustainability into those standard business operations a priority. I would say that the spotlight has perhaps shifted a little bit given the economic environment. Investors are focused on financial returns as they should be and the economic outlook of the business. But that doesn't mean that sustainable investing ESG has gone away. It's just very much assumed that these business practices are taking place. Bojana has referenced sort of these due diligence questionnaires. I've seen documents, 30 to 50 pages long on what Fiera is doing around environment, social governance practices. That's just a reflection of how sophisticated these questions have become, how involved they become. And I think it's just a reflection of where the market is at in terms of expectations right now.
John, I mean, would be great to hear some of your thoughts from your view. Again, Canadian based, but Colliers is has a global presence, and outside of both Slate and Fiera, through some of the work we've been doing, I have certainly seen kind of a continued interest in exploring for those who haven't yet started, and just kind of a steady progress for those who have. Maybe just from some of the research we've done and some of your experience and conversations with owners and the investment community, what's your take?
I think the nature of the conversation has shifted a little. The companies that are struggling a little bit more, that means the ESG priorities are still there, but they're still not, they may not be front and center. And like I think it was Bojana had said, the timeline may be different. What's really surprised us is that the number of, call it ESG service that we're providing back to the portfolios, it's up 30% year over year. It's a big increase. So we have more than 250 properties that are now certified, over 35 million square feet. We have 1 million square feet that went net zero a year ago. And in the pipeline for this coming year, there's 2.1 million square feet that are going to go towards net zero. So it's actually increasing. And part of that could be just that, Canada is quite far behind. If you look to what Europe and Bojana, what you experience in Europe, we're behind. And, if you look at it both from that, and Jag mentioned it from the investor perspective, but from the tenant perspective, all the governments here want they have ESG priorities and they're very clear about them. So if you have any tenants in that space, you have to be there or you're not going to be a landlord to them. Same with the Fortune 1000 companies. They all have ESG targets, and that means the landlords need to mimic that to play in that space. So it's still there. The goals are still there. If anything, they're growing because of legislation. But I do think the conversation is more muted, if that's the correct way of saying it, because everybody's trying to figure out economically, how do I get through this and still accomplish my goals? And just one last point, and Tanya, you've experienced this. Half of our clients actually have no ESG goals whatsoever, but your team has been brilliant going in and saying, well, if you're going to do this capital upgrade anyhow, what about considering this? And most of the time we get a positive response. So it may not be directly related to an ESG goal, but they're doing it anyway because they think it's the right thing to do and it's coming in at a good price point. So it's definitely still center stage.
So I want to kind of dig into that a little bit more, because we've talked primarily about investors and investments. We started to kind of move into the value for doing this, and why we're not seeing an abandonment, because of a couple other really key stakeholders in commercial real estate, and namely, lenders, clients, so the tenants and the occupants, the communities, insurers are a key stakeholder. I've got some thoughts on how and where they're kind of sitting compared to some of those other stakeholders, but Jag, maybe we'll look to you. Like when you think about, when Fiera looks at their clients, their prospective occupants, when you look at the lenders, how has that landscape been shifting outside of, I would say, in Canada, a very strong regulatory market? How are those stakeholders impacting what you decide to do or don't do?
Yeah, no, I think that's a wonderful question, Tanya. And I think that's sort of the most challenging part of sustainable investing in ESG is balancing sometimes what are competing interests. When we think about the ecosystem of stakeholders that an organization like Fiera has, recognizing that there's a certain trajectory that we need to move our assets towards, and balancing the pace at which we get there is one of the foundational elements of my job. When we think about, tenants, we have very sophisticated tenants that have net zero goals, that sustainability is a key priority to them and their investors. And then we have other stakeholders or tenants that are just primarily interested in keeping utility costs low. Now, in those two examples, those are two stakeholder groups that actually have the exact same interests, and the way that we approach these conversations with them will be customized based on their preferences. And Tanya, I think one of the main things that you referenced here is in Canada, the regulations both at a municipal, provincial, and federal level are robust. They not only impact our operational assets, but how we develop assets. And so recognizing that this is the direction that governments of all stripes are going to move us in, it's just risk mitigation from our perspective as one key driver to ensure the viability of our business going forward. And if we want to take the other sort of end of the spectrum where it's a value add, ensuring that the valuations of our assets are protected by ensuring that we're future focused, future proof, and aligned with future expectations. So those are just some of the drivers that allow us to align with these stakeholder expectations.
Mm-hmm. And Bojana, in some of our conversations and the work that we've been doing together with the Slate portfolio, some of the things that have come up within our conversations and consistent with what we're also hearing from some of our other clients is when it comes to lenders and kind of that environment. Maybe you could share with us again, both from what you're seeing in Europe, but how that is also looking here in North America for your portfolio.
I sit in London here in the UK, so I do very much get the European perspective. So in terms of the different stakeholders, perhaps adding a little bit more colour to what Jag said. So if you look at it from a lender's perspective, particularly those in Europe, one way to kind of take it back again is like lending, green lending. You've got green loan principles, sustainability linked principles with the various guidelines around that, but also taking that backward, the growth of the green bond market, which is kind of similar to lending, green lending, the approach and the principles there. It's over $1 trillion market now. That's how it's grown. It's phenomenal. And so I think that's now starting to go into the loan side. And there are some institutions, the more sophisticated institutions for sure in Europe, who have got very robust due diligence process when it comes to evaluating loans, especially when it comes to real estate. And some are even not deciding not to make loans in certain situations where they feel that the borrower hasn't got a robust ESG strategy in place. Another thing that I asked myself a little while ago is, with the talk around climate change and the risk of physical climate risk to real assets, how is the insurance industry and the insurers that we're purchasing our insurance from thinking about future climate risks? And so I delved into this topic matter a little bit more detail with our insurance brokers. And it was really quite enlightening and, if not surprising, in that the insurance industry, as I am led to believe, is all about risk. That's what the sector is all about. However, the majority of cases, maybe with a few exceptions, you get the majority of the insurance industry still looking at 100-year historical storm patterns. They're not really thinking at this time in any great detail, only just starting to as to what that risk might look like going forward. Now, that could be a function of the predictability and the robustness of the models that are being used. But the question that really begs and that comes to my mind is, there's a lot of talk around, we've got to make our properties resilient because that's going to lower insurance costs. Well, will it? Because as far as I can see from the discussions I've been having, resilience measures at the moment at properties, you can be spending up to millions of dollars on a resilience measures to make the property more resilient from floods or storms or whatever it may be, or what the physical hazard may be. But that is not being reflected in insurance premiums. So that part of the industry has to still catch up.
John, I think you and I have shared this experience with conversations with our clients. The general consensus, as both Jag and Bojana have articulated, is that there is risk in abandoning ESG commitments. There is this acknowledgement within the organization that we got to keep investing. We have to keep pressing forward. How hard and which things we prioritize or over others may be shifting, but generally there is risk in abandoning any of the commitments that have been made, and I'm finding clients are wanting to make more commitments, but really looking to our counsel on how and where and when and how aggressive to be, because they're learning from those who have gone before them, like Slate and Fiera, and your willingness to be transparent in sharing how you've been successful, where you haven't been successful, where you've learned. John, would you echo that? Are you seeing it different with different clients? Bojana referenced office versus industrial versus retail. What are some of your views on clients and their risk tolerance or lack thereof when it comes to ESG and sustainability?
Yeah, I feel like there is less discussion around risk in Canada. It is more of an economic discussion, and that I think is fairly consistent across the board. And again, much like what you said, Bojana, it's a different conversation in Europe, but it's still getting done. I think that's what really does surprise me. So I think there's awareness of risk. It is part of the calculation, but primarily it still is an economic discussion. And I think with office, there's a reality in office in North America that again doesn't exist elsewhere around the world. There's way more pressure in Canada and the US because of the vacancy rates. So it really is an economic discussion in those assets. But it's also a tale of opposing ends of the scale. So the high-end assets in AAA and A generally are doing okay. Occupancy levels are pretty good, and but they're servicing I'll call it that A and AAA tenant who have those requirements. So we're still seeing that rise. But then you have a tail of the older assets, whether they're C or B or even A, that are falling off the radar. because they can't afford to invest. They're not attracting the tenants. So we have a very different climate here. So in those assets, you're not going to see that investment. It's just economically not viable. In industrial, we are still pumping out a lot of industrial, and the new assets are meeting those types of standards already. And I know, like with Fiera, you're bringing some of your older assets, not old, but older assets up to net zero, and we're seeing that again across the board. And they're typically, again, with the larger, more sophisticated tenants. Retail, oddly enough, it's not a discussion with the customers coming into the retail. It's a discussion with the retail tenant and what their goals are. But that, I would say, is relatively slow moving. But again, it's become part of the conversation for sure. So I would say that conversation is definitely all going in one direction, up, but at different pace. There's a different pace with each asset class, and a different pace depending on that economic reality within each of those buckets.
When it comes to making that business case to invest in a project, both of your organizations, you started yesteryear on the small bits, but you have evolved quite significantly, and now these projects are commanding some significant dollars and cents. How does this show up on the balance sheet for your respective organizations? You hear a lot of clients talking about the value and measuring success from a reputational risk, and are they able to kind of win those Fortune companies as clients because their assets aren't going to impede kind of their ability to hit their own ESG goals as a corporation that they've committed to. But we've also seen some clients and progressives in other industries where they've even gone so far as putting an internal price on carbon within their organization and putting that into the balance sheet. When it comes to kind of getting the sign off on a sizable ESG related project at one of your assets or within your organization, what is expected of you to be able to demonstrate that it's successful? And I'm happy to hear an example of maybe when you were successful and maybe when you hoped you were, but it just was a bit of a dud, but you learned a whole lot and you were able to pivot. So all examples are welcome.
Definitely on the sustainable investing spectrum, there's a variety of initiatives that, one can pursue. So Tanya, as you're sort of describing the question, my mind goes to multiple places. Some projects are going to have very clear, very attractive, direct financial paybacks. Often we term them the low-hanging fruit. And, you can simultaneously be sophisticated, progressive, and still have many low-hanging fruits. In Canadian real estate, as we transact with our peers, often we purchase buildings where, investments have not been made in efficiency measures. So when we acquire an asset, we do our due diligence and understand what is currently in place, but recognize that through the acquisition, this might be a project that requires some additional work to bring it up to sort of Fiera's standards. So, it almost seems like there's this never-ending pool of opportunity, and as ESG professionals, it's our role to identify those opportunities and make those financial business cases. Now, with that being said, there are some measures where the ROI or traditional financial measures do not necessarily have that clear story, that clear narrative. And this is where our fund managers, our internal stakeholders, really need to understand the intent and the value proposition of some of these initiatives. And so specifically, when I think about it's not necessarily a dud, but a project that doesn't have a clear ROI, like a LED lighting retrofit, is through meters. As owners of property that traditionally have triple net leases, we don't necessarily see the utility consumption at the properties. And in order for us to collect that data, we have invested significantly in metering our buildings so that we can collect that information. Now, that data in itself, it's hard to put, a return value on it. But when we think about the fact that there are reporting and regulatory obligations associated with that reporting, recognizing that our property managers spend a significant amount of time collecting that data to meet those reporting requirements, all of those efficiencies that we gain just allow us to become better in running our business. And if we can stay focused on our core competency, these additional measures become less material in terms of the time and effort associated with it. So I think we need to be a little bit more evolved in how we shape a business case. It cannot always be around the dollar value, but recognizing that we have exceeding expectations going forward, recognizing that carbon pricing is also going to play a big role in these business cases going forward. There's so much uncertainty, but we know it is certain that it's coming down the pipeline. So the investments that we're making, we're confident in, but it's not always a clear-cut financial valuation around the measures that we're putting into place.
I remember being outside of a property in downtown Toronto where they've got a massive edible garden that has just grown over the years. That was something we were able to cost effectively do by repurposing some of our grounds budget, and rather than using it to plant annuals, we looked at native perennials and a garden. We run a farmer's market, and the harvests are donated to a local food bank that is always in desperate need of perishable items and fresh local produce. And I can't tell you the number of people that walked by and just stopped to tell us that it was their favorite part of their walk into work along that stretch of road. Just so lovely. You can't put a dollar value, but it gets the goosies going on my arms. And Bojana, I know Slate has done some really incredible work around restoring some communities through those investments. Again, would love to hear from your perspective how, again, that value is assigned internally, both quantifiably, qualitatively, and how that conversation sounds and looks like at Slate.
In terms of what we focus is, we do pride ourselves in the fact that we do focus on placemaking, and we see that with our developments team, and we see that in one part of our portfolio where we're particularly active on the kind of art scene, encouraging young artists to do some incredible pieces of artwork for the around on the buildings in the local communities where our properties are, and those are very, very impactful, and often they have themes, and they do raise up an area, and they do raise up the feel and look and the experience that local communities and the users of those buildings have within that area. And it's just very simple things, but quite impactful. And we think this is something that we really enjoy doing, and it's kind of like a system, not a system, sorry, but a legacy that we definitely would like to continue with and leave within local communities. Where I think it's going to start becoming a little bit more tangible for us, or I'm hoping, is the major development that we've got in Hamilton, which is our Steelport development. That is massive. It's going to go over decades, and it's got a huge social impact. And so we're now in the process of evaluating what the social element of that may be, starting with some quite detailed engagement and consultations with local groups and local communities as to what really matters to them on a massive project like this. And it's really interesting what you were saying on this actually earlier, Tonya, around how people really enjoyed going through the edible garden as they headed into work, and how they really it was just a really nice connection for them. One of the key feedbacks that we had, for example, with our major development in Hamilton is the green space, the desire for green space. Don't forget, it's been an industrial site for 100 years. So people are really desperate for green spaces. And I think that's something that we heard consistently across the board. We're hearing that from yourself with your experience. And so I think, the next kind of big thing coming through perhaps for real estate for our sector, not just climate change, is the impact on nature and biodiversity. How do we bring that into how we do business? How do we nurture that? How do we press a value on that, tangible and intangible? So I think that would be a very interesting area to watch. And so as part of this ESG framework that we've built out as part of this Hamilton development, actually looks at the S component and how we can start deciding what those KPIs may be to start measuring some of this element, whether it's from job creation, which is the traditional kind of economic measure, right through to how much green space we have as part of the overall part of the development, how many trees we may be planting. So those are discussions that we're having at the moment in terms of what that would look like and how that comes alive as the project starts getting off the ground. But it is, we're in it for the long haul.
Yeah, and I think we're certainly seeing more of it across Canada. With we put in over 80 local planting and pollinator gardens in properties, which is replacing those annuals and whatnot, and really connecting with the local biodiversity. And it's been a big hit. It's been a big hit right across the country. Owners are participating. More often than not, the costs are actually coming down because you're not having to procure all the same material that you were doing on an annual basis. The one where we talked about an edible garden, we know the client was actually using that on social media and was getting a huge response, a positive response, not just from their own employees, but from people in that corporation's community. So I hear what you're saying. There is an intangible component to it. And it's just, again, it's finding the balance with the economics and making sure you're hitting some of those things, because part of it is just a feel-good thing for everybody involved. And it doesn't necessarily take a lot of money to do that.
Yeah, and I would also argue about the fact that, with the jobs that we have and the roles that we play within the organizations, and to Tanya's earlier point about bridging that connective tissue, we're not just the connective tissue, but we're also agents of change. That's how I see myself. We're trying to change how people think, how people do things, and that's a big lift.
How do you get to that scale that's really going to catapult us forward beyond kind of the individual projects? For us, for my team here, again, we've got a really solid group of in-house experts, and even with that growing team, we can't do it all. So what we've been doing, and we've recognized that we need to do more of to really catapult the commercial real estate industry forward with a squarely focused on impact outcomes versus the inputs, is really helping our property managers understand what ESG looks like, what sustainability looks like, what those impact outcomes look like, and really bring kind of that view to the day-to-day management of the asset.
From my perspective, I think the key is, and this is something that we've been talking about for some time within my team. So yes, Tanya, we've got a pretty small team for the size of organization that we are at Slate. There's only 2 of us doing ESG at Slate. However, intentionally, I am not looking to build out a big ESG team. Only because past experience has taught me that the minute you start building up a sizable ESG team, anything that's labeled remotely ESG gets pushed into the ESG team, and everybody washes their hands off this. And so that's one of the rationales here. And so keep the ESG team small but still effective, and that internal area of expertise, but working really closely as that connective tissue with your other teams and your other colleagues to bring them up the learning curve. And I think what's really key is training and education and awareness raising, and it's learning by doing. What we've noticed is that when we first started, it was that, oh, rabbits in the headlight moment, to now we've been doing this for a little bit of time. And as we bring teams up that learning curve, what we're finding is, and also due to things happening in the marketplace, whether it's regulatory driven or other, we're finding that teams are forced to look into specific situations. And sometimes it is cutting it to the point where they go, we don't know what to do. we need to understand this. There's a deadline here, and then it becomes an aha moment. So, for example, there's regulation being introduced across certain states in the US. We've got a big portfolio in the US where certain states are regulating for carbon benchmarking of properties of a certain size and carbon reduction. And this is called catching some landlords unawares. Slate wasn't one of those, but it is really mobilizing the team to kind of understand, what do we need to do? How do we capture this? How do we get there? Can we get there? There's a bit of discussion. It's not for our landlords, but it's a piece of regulation. You have to meet it and you're forced to do it. And so I think that opens up a whole new discussion on ESG, the things you need to be doing, what's best practice to get you to that end goal, just to meet the minimum ESG regulation. But with that comes a steep learning curve for the teams, which is great. I'm kind of secretly rubbing my hands together thinking this is fantastic. Clearly, regulation can be sometimes a bit of a blunt tool, but gets things moving. And so that's where it's been our experience. And then other parts of other teams are coming to us because they're realizing that in the market that they're operating in, the type of investors we're looking to attract will not look at a property if it doesn't have a net zero plan in place, full stop. So now we are piloting net zero decarbonisation plans for properties in specific regions where we know this is going to be a big focus for future investors. And the proof will be in the pudding when the time comes to move the property on, to sell, whether indeed that's the case. So we're still learning, but teams are coming to us and asking for that help.
I agree with everything Bojana said, and perhaps what I would add on to it is I think my experience has shown if you start with empathy and if you start with understanding, you'll go a lot further. I think if you really spend that initial investment in understanding the constraints of the partners that you're working with, the stakeholders that you're working with, and understanding that just because they don't necessarily align with the implementation plan for your ESG initiative, it's not because they're climate deniers or they don't believe in sustainability. It's that they may be working with very tight budget constraints on the development side of things. Pro formas can be very tight. And so recognizing that it's not just resistance, it's resistance that is the symptom, and it's not the actual cause here. And so by having an understanding of, we have a common goal, you have different constraints than I do, how can we arrive at that same destination together is the different way than I think sustainability has traditionally been framed, which is, the folks that are controlling the purse strings may be very conservative, maybe very financially focused, and they don't want to spend any money on what might be deemed altruistic initiatives. And so just reframing that approach, I think, has done wonders. It can take you a lot further in achieving ultimately what is a mutual objective.
And what I'm hearing in, kind of the underlying theme in what you've just shared between the both of you is a bit of a rallying cry to your peers, to the industry, and that theme of understanding and preparedness, right, is one of those core things that we're certainly seeing on our end, where we have clients that have a bit of trepidation, and where we're starting to see the conversation shift is, what, let's just focus on preparedness. Do you have the information you need to make a data-driven decision? You don't have to go to Fulbright, but with some insight by looking at the asset, the fund, the portfolio through this ESG lens, we've got an internal assessment tool that we to help unpack some of that and bring that data and insights to our clients. We're starting to see a lot more interest pick up on, what, I'm not ready to move, but maybe next year. So can we do some preparatory work now that would help us really learn and scale relatively quickly? Because, those who've been trailblazers and leading edge, you're able to muster enough data to get you to the start line, and then you find out you're missing this, you're missing that, and it kind of takes a little bit longer. So, John, maybe, are you seeing a similar kind of theme to, getting things moving as Bojana and Jag have expressed, or something different, given the fact that there's a slightly different economic environment at this time?
No, what I would say is data is driving a lot of things now, and having more data, better data is helping, I think, the investors to make more informed decisions and faster decisions. So, we talked about regulatory environment. I mean, that is changing across the globe. It will continue to change. There is no question. It's just going to happen at a different pace depending on where you are in the globe. But staying on top of those changes, understanding what's coming down the pipe, is super helpful for clients. Like, just having access to that information means you have a sense of what to prepare for. The second aspect is to keep on top of the innovation that's taking place in industry, because that does change the economics as well. So again, it's that data, having data, what's going on in the industry. One of the primary reasons we started the PropTech Lab was to stay on top of what's changing in the industry and to have quick information for a client, so you again could get to a decision more quickly. So having that data, and then staying on top of what tenants are actually after. And it's why we shifted our surveys now to get more of a psychographic demographic. It's to be able to go back to the management of the tenant as well as the investor and say, hey, the occupants here are looking for this, and they're going to be happier, they're going to want to stay here, and they're going to be willing to pay to stay here. So I find that data has become a very big ask coming from almost all corners to be able to monitor and justify investment in the right areas so that you're putting your money smartly towards things and getting the results you need.
It's been such a fantastic conversation. This is one that I think we could probably continue for another hour, but for the sake of our listeners, we hope to unpack some of the bigger concepts that we very, very quickly glazed over today, as we really tried to hone in on some of the timeliness of this conversation, given the state of the economics, and so I really am appreciative of everyone's time. I think for me, what I'm hearing from you, and I'm hoping that the listeners take away, is that done well, ESG, sustainability, social impact, these contribute to thriving communities and thriving businesses, resilient businesses with a long-term view, that it's smart for business, it's smart for the communities, and it sure as heck makes me feel good, as someone who got into this space really, really wanting to affect positive change. The commercial real estate space, we occupy a lot of physical space, land, and I think we've all woken up to the reality that we are a critical piece in the solution going forward. And it's just been an unbelievable journey to work alongside Bojana and Jag, and with the trust and the investment of Colliers to build out this internal capability so that we can collaborate, we can be an extension of your internal teams and bench strength to really help you deliver on your organization's visions, respectively. Slightly different, which I think is a theme that came up today, a little bit different. It's not all the same, but at the end of the day, our impact outcomes are the same. Do less harm, do more good. So with that, thank you all again for your time today. Look forward to future conversations and doing more great work with all of you. Thank you to the listeners. Have a great day.
Thank you.
Thank you.
Thank you.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.